Eventually something will break. JP Morgan strategist warns rising bond yields could unleash a financial accident. Here's one reason investors might consider betting on a bond market rebound. If prices keep falling, and yields keep rising, it could trigger a financial catastrophe. Given the uncertainty around how the U.S. economy might react to sharply higher interest rates, David Leibovitz, global market strategist at JP Morgan Asset Management, said one would expect bond yields to be moving lower, not higher. If rates continue to rise the way that they've been rising, eventually there will be a financial accident, eventually something will break and that will get the Fed moving in the other direction, he said. Although stocks slumped during September, with the S&P 500 booking its worst monthly performance of the year, the fact that stocks remain relatively sanguine makes little sense to Leibovitz. But it seems like the equity market still has this idea that the Fed is going to ease for easing's sake in 2024, and I just can't get there, he added. JP Morgan Chase & Co. CEO Jamie Dimon recently warned that investors and the general public aren't prepared for interest rates to go to 7%. Worries that rising yields could stoke even more widespread problems have resurfaced as long-dated yields pushed higher in September. Bond prices move inversely to yields, falling as yields rise, and vice versa. Rising yields on Monday put renewed pressure on stocks as an overnight rally in stock futures inspired by an unexpected deal to avert a government shutdown in Washington fizzled. The yield on the 10-year Treasury note BX TMU/BM/USD 10Y was up 6.9 basis points to 4.641% on Monday, nearing its highest level since October 16, 2007. Yields are already trading at their highest levels in 16 years.